Hey everyone, in this video I'm going to do a financial statement analysis of SoFi stock. Now this is going to be a very introductory financial statement analysis intended for non-financial professionals. So I'm going to keep it as simple as I possibly can, but still there could be complex topics that might confuse some of my viewers. So if there's anything confusing, feel free to ask in the comment section below and I'd be happy to clarify for you. There aren't going to be too many numbers in this financial statement analysis because I'm going to keep it introductory and not get into those details as much. So let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so let's start with the business overview. SoFi says that they are a one-stop shop for financial services that through their lending and financial services products allow members to borrow, save, spend, invest, and protect their money. SoFi aims to be everything in terms of financial services for their clients. They want to be there for you for every financial need you may have, whether it be borrowing, investing, anything you may need financially, any big life decision that requires financing, they want to be there for you. And that's their intention. So it's a big, big, ambitious goal from SoFi. So right now they offer personal loans, student loans, home loans, and related servicing. And what is glaringly missing here is auto loans. And I wouldn't be surprised if over the near term, SoFi enters the auto loan business as well, because that's missing in terms of if you look at their overall plan, they want to be there for you in every big life decision. Buying a car is a big life decision, and so I think SoFi would want to be there for you in that area. So I wouldn't be surprised if they launch a service of auto loans sometime soon. So SoFi says that they believe that some of the current frictions faced by other financial institutions are caused by a disjointed and non-seamless product experience, a lack of digital customer acquisition, subpar mobile and web products instead of digital native apps, and incomplete product offerings to meet customers' holistic financial needs. And for the most part, I would agree with SoFi. And if you've ever used Bank of America, you would know exactly what they're talking about. Bank of America's technology feels like it's from 20 years ago. They seem like they're so far behind the digital area. And SoFi is aiming to be better at that, to be more digitally native. And instead of spending money on brick and mortar branch locations like Bank of America does, SoFi instead will invest in the digital capabilities. And so that's early. That's a little early to tell whether that's going to be a more successful strategy versus spending money building out brick and mortar locations. On the one side, it makes people feel comfortable if they have a bank branch in their neighborhood that they can go to and speak to somebody in person. On the other hand, younger customers prefer having an app, a website that's more accessible, more usable, more intuitive to use. And that might be a more valuable way to spend your capital, to spend your energy, and build out your business in that way. But it's early, so we don't know for sure if this is going to be a smart strategy or if later on down the road, SoFi is going to say, you know what? It seems like we do need to build out that brick and mortar presence as well, because that's how customers have gotten used to banking. So we don't know that yet. We just know what decision SoFi is making right now. So not only is SoFi working with consumers as customers, but they also have businesses as customers. Other financial institutions are customers of SoFi. SoFi offers them their digital capabilities. So their products and capabilities are designed to appeal to enterprises such as financial services institutions that subscribe to their enterprise services. They've made some strategic acquisitions to build out these services, including the acquisition of Galileo in 2020 and the Technicis merger in the first quarter of 2022. Also, they closed a deal to become a bank. So in February 2022, they closed the bank merger, And so now they've become a bank just in the last year and a half or so. The expected financial benefits of being a bank are that it's going to lower their cost to fund loans as they get deposits. It's going to increase their flexibility to hold loans on the balance sheet for longer periods. And it's going to support origination volume growth by providing an alternative financing option. And finally, through deposits, it's going to provide them with meaningful member data that can allow them to better serve their customers and financial needs. So let me go through each one of those. So the first one, they're lowering their cost to fund loans. Yes, that's true. If SoFi wanted to continue making loans based on what investors and other lenders were willing to provide them, the money that they're willing to provide them, that would cost them more money. Investors and other banks would require more from SoFi to get access to those funds versus what customers are willing to give SoFi. Now, right now, SoFi offers one of the industry leading APY for keeping your money in the bank account. So they're paying a pretty penny for customer deposits. But longer term, once they establish their customer base, I think they can lower those costs. People have been known to leave money at the bank even though they give you zero, right? Bank of America, again, I don't mean to continue picking on them, but they seem to be the worst in the bunch. Wells Fargo is also pretty bad with their, open one account, get 5 accounts policy. But SoFi right now is a newer bank, so they need to offer you more to switch to SoFi. But in the longer term, they may not need to offer you so much to keep your money at SoFi. Right now, people are keeping their money at Chase, at Bank of America, getting 0% on their deposits. So longer term, I think that's going to continuously decrease their cost to fund loans. And then it's going to increase their flexibility to hold loans on the balance sheet. Prior to becoming a bank, they were more inclined to need to sell when they make their loans to securitize them, bundle them, and sell them so that they can get more money so that they can make more loans. But if you've got all these customer deposits and it's growing, that's more and more money that's coming in that you can use to make loans. You don't need to sell your existing loans to make new loans. And so if you keep those loans on your books for longer, you can earn the interest expense for that much longer. You can earn more from each loan that you make. So it's also going to support origination volume growth by providing an alternative financing option. Now, if you recall, I've done some videos on Upstart. I always get those two confused. Upstart. Upwork is the working model, and I've gotten comments on this before, and I'm sorry for that. So Upstart is a online lending company that uses artificial intelligence to make loans. They've been struggling because the lenders on their platform said they wanted to make less loans because they feared a recession was coming up. So they took out their money and they stopped making loans on the platform, and that hurt Upstart. Well, SoFi is not exposed to that risk, or is less exposed to that risk since becoming a bank, because they have those customer deposits that they can use to make loans. So it gives them more flexibility. So, and then finally, through deposits, they get more data, right? They can see what you're spending your money on and what you're looking at, and that way they can better offer you services and use that data to make more money. Essentially, that data becomes an asset. If they see that you're using your debit card to buy luggage, or maybe they see that you're using your debit card to buy insurance, or what you might be doing with your money, they could see where you're heading and what products you might need. For instance, if they see you're using your money to pay for college tuition, or maybe they see you're using your money to pay for lunch at a college campus, they might say, oh, you might need to refinance your student loan, and they can send you offers to refinance your student loan. And so that will help with the business because they have more data. All right. So this explains a good deal about SoFi's core business and what they're doing, how they're doing it, how their moves are impacting their business, and what investors in SoFi can look for. One final thing I'll highlight here is you've noticed 1, 2, 3 mergers or acquisitions, and there's one here that they haven't listed, is they bought a home mortgaging company. So 4 acquisitions in the last 3 or 4 years. That's not an easy thing to do. That requires time and energy and effort to digest and incorporate those acquisitions. So in the near term, SoFi may be constrained in their growth because they're spending time integrating these businesses. But once fully integrated, it should lead to better growth for SoFi because they've got these businesses set up in a way that they like it, and that time spent integrating, time spent bringing people on board, training people in your ways, that time can be spent more on customer acquisition and revenue growth. All right, so I hope this has highlighted some insights into SoFi for those of you that are interested in SoFi stock. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.